What is going on, my friends? It's great to see you guys. My name is Ryan Williams, and we have a very jam-packed video today. Not only are we going to be talking about some dividend stocks in the utility sector that may be some good buys right now, but later on in this video, I'm also going to reveal the newest addition to my dividend stock portfolio. That's right, guys. I finally took the plunge into the technology sector, and I'm very excited to show you guys which stock I bought and why I bought into it right now. So stay tuned for that, and just a couple of things before we get rocking and rolling. Number one, give this video a big thumbs up if you guys are excited to talk about some dividend stocks today. Number two, leave me a comment below. Which stock do you think that I added to my portfolio? Any guesses? Anyway, thank you guys so much for doing those couple of things. And now, without further ado, let's get into it. All right, guys, now before we get into these utility stocks today, I do have one announcement. So recently I was invited to be a guest on my friend Darren's YouTube channel, which is called Invest with Darren. And in this video, which actually just was released today, we covered a lot of good ground. We talked about investing, talked about some dividend stocks, talked about some cryptocurrencies. He even got me talking about Tesla, which does not happen on my own channel. So if you guys want to give that video a watch, like I said, we talked about a lot of really good stuff. The link to that video is in the description below. Definitely check it out. Give Darren's channel a watch and a subscribe, and let me know what you guys think of the video. It was a lot of fun, and Darren, if you're watching this, my friend, thank you once again so much for having me on your channel. It was really fun being able to chop it up with you and talk investing, so let's do it again sometime soon. All right, now moving on, as far as the utility stocks goes, guys, I was recently just going through my portfolio, just checking out some of the performance of my stocks, and I realized that both of the utility stocks I was holding were performing really well. And for those of you who don't know, I currently own Southern Company, ticker symbol SO, and American States Water Company, ticker symbol AWR. But as I said, they were performing very well. And as you guys can see on the screen, just in the last month, Southern Company is up 4.6%. and AWR is up 4.01%. And if we look back even farther across 6 months, you can see that both are up in the double digits in that time, which is pretty great. So seeing this got me a little bit curious and made me want to do a little bit more research and see, is it just these two stocks that are, doing so well, or is this something that is going on sector-wide across the entire utility sector? So from here, I probably combed through maybe 8 to 10 other utility stocks, and I would say that all but one of those had appreciated more than 2% in the last month. So it seemed to me sector-wide utility stocks were doing pretty good, but I was not going to go into this video just talking about that many utility stocks. That would be a lot. So what I did is I narrowed it down to 4 utility stocks that I think could possibly make for good investments right now. And the two that we're going to start with are the ones that I'm holding in my own portfolio, Southern Company and AWR. And starting with Southern Company, guys, I know we touched on it a little bit, but as you can see on the screen, in the last year, Southern Company is up 24.43%. So it is just banging. And then year to date, Southern Company is up 7.46%, which is also pretty impressive. And then in the last 6 months, like we already covered, up 10.29%. And in the last month, 4.60%. So Southern Company has been performing really well, at least in the last year, in the last 365 days. And what's crazy too, if you look on the right-hand side of the screenshot, despite these substantial gains in share price, Southern Company is still looking relatively affordable. Just if we're looking at the PE ratio here, 19.79, which does indicate some affordability here. Now, this is just a quick number that we use as reference to determine the affordability of a stock. And some other metrics that we can look at that also could point to some affordability on Southern Company's end is the price to book ratio, which I don't have a screenshot for it, but at the time of this recording, it's 2.34, and then price to cash flow, which is in the single digits, 8.59. Now the price to book 2.34, that's not perfect. Ideally, a perfect price to book ratio is 1.0. But the price to cash flow being in the single digits is a number that we'd like to see, and does align with the PE ratio to indicate that Southern Company is still looking like a somewhat affordable stock to buy right now. And switching gears for a moment, you guys know we got to talk about the dividend. So as far as Southern Company's dividend goes, it has a forward yield of 4.0% or 4%. I don't know why I made that difficult. A payout ratio that's actually relatively high, 79.16%. A 5-year growth rate that's kind of low, 3.35%. but a 4% dividend yield, that's good enough for me. And also Southern Company has pretty consistent dividend growth. So they've been growing the dividend for the last 20 consecutive years, which is pretty solid. 5 more years, they'll be in the Dividend Aristocrat Club. All right, guys, now moving on to utility stock number 2, we have American States Water Company, ticker symbol AWR. And as you guys can see here on the screen, AWR in the last year is up 14.26% with a year-to-date gain of 12.26%. And the last 6 months for AWR have been very good, up almost 14%. And I bet you guys that's about how long I've had this stock in my own portfolio, but we'll get to that in just a moment. In the last month, AWR is up 4.01%, which we talked about earlier. But this is just another one that seems to be performing really well. The difference between AWR and Southern Company so far is that AWR is not looking as affordable as Southern Company is. So as you guys can see on this screenshot, the PE ratio is quite a bit higher than that of Southern Company. So AWR has a 36.38 PE ratio, which is nearly twice the size of Southern Company's PE ratio. And also, I don't have a screenshot for it, but the price to book for AWR is also considerably higher, sitting at 4.87. So AWR may not be the most affordable company to buy right now, but I can say, just speaking personally, it's been doing really well for me in terms of performance goes. So like I said, I don't think I've held this company for more than 6 months. It's actually one of the more recent positions I've added to my portfolio. And my position is up about 15.3% at the time of this recording. So like I said, guys, for not holding it for very long, it's been doing really well. Now, if it's a good one to buy at this present time, that's another story. Let me know what you guys think in the comments below, and definitely look a little bit more into this company too, because this one I think is kind of under the radar, kind of underrated, and kind of lives in the shadows compared to other utility stocks like Southern Company or Consolidated Edison, ticker symbol ED, or some others out there. So let me know what you guys think of AWR in the comments below if you do any research on it. But switching gears, let's talk about the dividend real quick. So looking at this screenshot, guys, we can see that AWR has a forward dividend yield of 1.64%, a payout ratio that's actually within the sweet spot, 59.51%, a 5-year growth rate that is considerably higher than that of Southern Company's, sitting at 8.86%, which I like, and then dividend growth history of 12 years, which is really not too shabby. And in case you guys were wondering, so AWR has 12 years of consecutive dividend growth, but they've actually been paying their dividend for the last 65 straight years, which is a long time. So I do think this dividend is pretty secure, is pretty safe, even though the dividend growth history is not the highest. All right, guys, now moving on to stock number 3, we have Consolidated Edison, ticker symbol ED. Now, this is a stock that I do not have in my portfolio, and I will say that compared to the last 2 stocks we've talked about, this one has not been performing as well. It's still up, don't get me wrong, but it is not appreciating quite as quickly as Southern Company and AWR. But as you guys can see on the screen, in the last year, Consolidated Edison is up 4.43%, which is really nothing to write home about, especially considering how inflated so many other stocks are right now. I mean, everything's just really skyrocketing in value. Year to date, Consolidated Edison is up almost 6%, just shy. In the last 6 months, it's actually been performing pretty well, 9.40%. And then in the last month, we see Consolidated Edison is up 2.23%, which, you know, isn't as high compared to the other two, but is actually still pretty decent. And I'll tell you guys what, I decided to include this stock in today's video, not so much because of how the share price has been performing, but more so because of some other variables like the affordability. So as you can see on the right-hand side of the screenshot, Consolidated Edison has a PE ratio of 18.01, which indicates some affordability, a price to book ratio, which I don't have a screenshot for this, but it is sitting at 1.34, which is the best we've seen all day. I've been hard pressed to find a stock with a price to book ratio in the ones, so seeing this one as close to 1.0 as it is really indicates that it might be a good time to pick up some ED. And then the price to cash flow indicates the same thing. I once again don't have a screenshot for it, but 6.96 is the current price to cash flow for Consolidated Edison, which single digits. Okay, I like that. That's a good price to cash flow. So really, guys, these 3 metrics combined, all signs point to an affordable Consolidated Edison. And then another reason that I really wanted to talk about this stock today, or I'm actually kind of hyped on this stock, is because of the dividend. So as you guys can see on the screen, ED has a 4.05% forward dividend yield, a payout ratio of 72.88%, which real quick, while we're on the topic of payout ratios, it seems like more utility stocks than not have a higher payout ratio. Now, I don't exactly know why that is, but if you guys do, if you know why a lot of utility stocks have a somewhat high payout ratio, let me know in the comments below. I'd be curious to hear. Anyway, moving on, Consolidated Edison has a 5-year growth rate that's a little bit low, 3.04%, but their dividend growth history is very impressive. 47 straight years of dividend growth. That is the highest we've seen all day, and they are 3 years away from becoming a dividend king. Now, I don't personally have this stock in my portfolio, but I will say that at this present time, ED is looking like a better buy than AWR, just based on what we've seen today. But once again, you guys might do your own research and find something different. And if you do, let me know. You got to fill me in. Don't leave me in the dark on this one. All right, now moving on, guys. The last utility stock we are going to be talking about today is UGI Corporation, ticker symbol UGI. Now, I gotta say, UGI is probably one of the best performers that we've seen today. In the last year, it is up 36.14%. Year to date, it's up and almost as impressive, 34.81%. In the last 6 months, it's just been crushing it with a gain of 19.23%. And then in the last month, we see it's up about 2.25%, not too far off from Consolidated Edison. So just going back over the other stocks we talked about today, like without a doubt, UGI has appreciated the most in share price in the last year, even in the last 6 months. It's really knocked it out of the park. And even with that, if you guys look at the PE ratio here, 15.55, still indicates some affordability for UGI. And talking about the price to book, which is 2.04, and the price to cash flow, which is 8.53, that does point to kind of the same story. The price to book is a little bit high. It's not as low as the last stock we talked about, but 2.04 is not too bad. And then the price to cash flow, single digits, looking good. Now, as far as the dividend goes for UGI, it has a forward dividend yield of 2.93%, a payout ratio that actually is the lowest we've seen all day. I might want to retract my payout ratio statement with the last stock. A 5-year growth rate that's actually pretty decent, 7.73%, and then a dividend growth history of 18 years, which is not too shabby, guys. That's pretty good. Now, UGI is actually a company, I don't really know much about it. I just stumbled upon it as I was doing research for this video, but I do think that it is one that I'm going to look more into. I like the dividend stats. The dividend yield is a little bit lower, but I do like the growth rate and I do like where the payout ratio is at. However, just going back a little bit, I do also like what I see with Consolidated Edison. So I'm personally not in the market for another utility stock, but if I was, I might choose one of these two. Just at a glance, Consolidated Edison is kind of looking like it would take the cake, but I need to do a little bit more research. All right, now that we have made our way through those utility stocks, it is time for the big reveal. So guys, in case you didn't know, there's actually been a lot of you guys who have guessed the stock already. I put out a community post on it a couple days ago, and a lot of you guys already know which stock this is. So let me spoil it. The stock that I added to my portfolio is Intel, ticker symbol INTC. And I know already that some of you guys are probably going to disagree with this investment, and I may get some backlash for it in the comments below. But I think if you're gonna buy into Intel, I think right now is a really good time to do it, and I will explain the best that I can. I've tried to do this before in other videos, but let's get into it once again. So as you guys can see on the screen, just in the last 6 months, guys, Intel is down so much. It's at a 15.29% discount, okay? And then in the last month, Intel is down 5.26%. So one of the reasons I decided to buy into this company right now is because of what we've just seen. It is at such a discount, guys. It just keeps going down in price and becoming more affordable. So when that happens, guys, it just makes it hard not to want to pick that up. And I've been eyeing this stock. It's been sitting in my watch list for the last couple of months. And in that time, I've been reading up on it. I've been trying to do as much research as I can and get to know this company as best as I can, just with the understanding that I have before buying into it, because you don't want to rush into these things. If you're going to be buying for the long term, you should be pretty familiar or pretty dang familiar with what you're buying and why you're doing it. So reason number one that I'm buying into it is because it's such a discount right now. And number two, which goes hand in hand with number one, okay, just look at the PE ratio, 10.92. It's very low, it's very affordable. Price to book for this stock is 2.36. Price to cash flow is 6.98. Okay, everything there points to Intel being a very affordable stock to buy. But let's talk about the reason that this company is so down. So this is something that I covered in a recent video when I was talking about Intel, but I'll touch on it again, and I'm sure most of you guys know at this point, there is a worldwide chip shortage, and a lot of companies that make the type of products that Intel does, microchips, stuff like that, some other companies are going to be NVIDIA, AMD, those are ones that you've heard of. They're all affected by it too. So that is one of the reasons the sentiment for this stock is so down, and that may be one of the reasons you guys would not recommend that I buy into it. And reason number two this stock is so down, which is probably the main reason why a lot of the naysayers, some of you guys out there, don't think that Intel is a good investment, is because it's really fallen short to some of its competition. However, despite this, I still see a bright future with Intel. It is still one of the biggest players in the microchip game. It is still such a big company. It's still pretty profitable. And they also have a new CEO who seems like is going to try and change the direction and change the tide for this company. And to elaborate on that a little bit, I will read from this article that I found on seekingalpha.com. And the article reads, "This year and the last have seen several major changes for the Intel Corporation, both in good and not so good ways. Start with the not so good ones. Overall, Intel's chip business has been facing challenges from multiple fronts. In the customer front, it lost Apple's Mac computer business, ending a 15-year relationship. In the high-end manufacturing front, Intel has been passed by its Asian rivals such as TSMC, which is actually a stock that you guys have told me about in the comments below. Anyway, to manufacture smaller transistors and superior chips. In the chip design front, it has been in a cutthroat competition with other giants like AMD, Qualcomm, I think that's Qualcomm, right? NVIDIA, and does not show clear signs of winning." Here is the good news. I'll continue on in this article. Now more positive news. First, Intel is still a powerhouse and leader in many ways in the chip sector, and the business is still highly profitable as seen later in this article. Secondly, the company had a new CEO, Pat Gelsinger, or Gelsinger, I don't know which one, a 30-plus Intel veteran. Gelsinger brings tremendous expertise and vision to the job. One of Gelsinger's key initiatives is a shift from its decades-old strategy as a chip design firm who outsources manufacturing. Gelsinger is instead determined to double down on manufacturing. The strategy is to not only gain back Intel's manufacturing superiority of its high-end chips, but also to sell its foundry services to other customers. Intel is committing $20 billion in 2 new chip factories in Arizona, and the foundry market is estimated to be worth $100 billion in 2025. To put things in under perspective, Intel 2021 total sales is about $73 billion. As an Intel investor myself, I welcome such move, both as a growth driver and also as a diversification of the business income streams. So let's unpack this just a little bit, guys. So one of the moves that Intel will be making is to put more of an emphasis on manufacturing, not only for themselves, but also they'll offer these manufacturing services to some of the other companies right there, which is gonna be a completely different income stream for them. So like this article says, it's good to diversify your income and bring in extra revenue streams in the event that maybe you lose a contract with Apple, or maybe you're losing out to competition. You can create income elsewhere. So that is one of the things that Intel is trying to do. And as you guys saw in the article, manufacturing could be big in the next few years, okay? Especially with the chip shortage right now. A lot of people are hurting for those chips, and if Intel can deliver those or provide those, that's gonna be good for them. So we'll see how this plays out for Intel, but moving on, guys, as I mentioned earlier, Intel is still a pretty profitable business, okay? As you guys can see on the screen, the gross profit margin in the last 12 months is about 55.5%. And then going down a couple rows there, you can see the net income margin is almost 24%, which is pretty high. And they have a levered free cash flow margin of 8.5%, which bodes well for the dividend, which brings me to the next point. They have a forward dividend yield of 2.66%, a payout ratio that is pretty low with a lot of room to grow, 29.08%, a 5-year growth rate that in my opinion is neither too high nor too low, 6.12%, which seems pretty sustainable, and a dividend growth history which hopefully will continue as time goes on. I'd like to see that a little bit higher, and is actually considerably lower than some of the other companies in this space, in the technology space like Microsoft or even IBM, but their dividend growth history is 7 consecutive years. So hopefully they continue to grow it. And then looking at this next screenshot, guys, even though they do only have 7 years of consecutive dividend growth, we can see that they've been paying it for 28 consecutive years. All right, guys, so hopefully this helps paint a little bit of a picture and helps explain why I decided to buy into Intel right now. I feel pretty good about this investment, but I know there's gonna be a lot of you out there who probably think differently, which is totally fine. That is the beauty of investing and building your own portfolios, that you can fill it with whichever stocks you think is the right move. And also, there are some risks to investing in this one. I think them, losing some market share to NVIDIA and AMD specifically is, you know, not the best thing, and that does have me a little bit concerned. But I'm not building a huge position in this stock right now. I'll probably give it like a 3% allocation in my own portfolio and just hold it from there. So even if, you know, you guys end up being right and Intel just kind of takes a dump, or even more of a dump than it already has, you know, I'm not losing out on too much. But it's at such a value right now that I had to get in while it was still low, just in case my bullish feelings are correct and this stock rises from the ashes and goes back up in share price. There's a lot of upside potential with Intel, which makes me glad that I bought into it right now, because I would love to be around and take advantage of that upside potential. I feel like I really bought it at a value here. So in closing, hopefully that makes sense to you guys, and you know, you can understand why I bought into it right now. And with that said, guys, that's pretty much all I got for you in today's video. Like I said, this was a very jam-packed one. We covered a lot of ground. And if you are still with me here at the end of this video, I really appreciate it. And if you have not done so already, don't forget to leave a like, leave a thumbs up on this video before you click off to the next one. Also, if you enjoyed this content, I would ask you to consider subscribing to my channel. I'm putting out videos specifically on dividend investing twice a week. I upload every Sunday, I upload every Wednesday, and I'm pretty religious about that schedule too. I really don't miss uploads, or at least I try not to. I haven't for a few months, knock on wood. But anyway, I'd really love to have each of you along for the dividend investing journey, so please consider subscribing to the channel. Anyway, with that said, I will now get out of your guys' hair. But thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.